Okay, welcome back to Financial Accounting Info. This video, we want to look at the preparation of departmental accounts. So we are going to look at question 5 on that question paper. So question starts with the required part whereby it reads, I use the information given below to prepare the departmental income statement of regional traders for the year ended 20 February 2014. So you're given information whereby first point, you are given regional CAF consists of the following two departments. So we've got two departments in the business, which is takeaway and restaurant. And then beneath that, all goods are marked up at a 25% of cost. So basically, this is going to be our markup, which is 25%. The last point, this business operates by using the periodic inventory system. So very important to take note of the inventory system that is being used is periodic. Then the following statement reads, the following was extracted from the accounting records of 20 February 2014, whereby we've got the takeaway department column and then the restaurant department, and there so we have got the information that goes down that you need to take notes. Going down, we have got additional information that we have there. Then all the additional information, we are start with the additional information number one, where we have the allocation of workers and floor space. So you need to go through the information that we are given. Then going to the next page, you see that we have some additional information, continuation of additional information that we have there. So let's just try to see we've got from information 2 going down to information 7. So this is the information that you need to go through before you start to answer the question. So going back, you'll see that we have got our answer section where we are going to prepare the departmental income statement for regional CAF. So we've got a column for takeaway department and then the restaurant department. So we are just going to end up in the respectable columns. So we're going to start with the figure for sales. So here we are going to say sales. Remember, this is an income statement. So we are saying sales. Then we can go to the question to try to see what figure of sales do we have in terms of the respective departments that we have there. So coming here, you would see that we now have our sales whereby we are having for takeaway department, the sales figure that we have is here is 525,000. And then we've got the sales figure for restaurant 369,000. Then we check if we've got any sales returns. But if you come here, you see that we have some sales returns that are here that we need to subtract for the figure for sales to get the figure for net sales or turnover. Then for takeaway, we have got sales returns of 1,000. Then for restaurants, we check there, we see that we have got 200 as our sales returns. So we can try to calculate as such, whereby we are saying to calculate the figure for net sales, we start with takeaway. So for takeaway, we are saying for takeaway, we are saying the figure that we have for sales, we got 525. Then we subtract the figure for sales return that we are given there, which is our 1,000. So there, if you subtract there, we're going to get your 524,000. So it means 524,000 is the figure that we're going to put there in the income statement. Then obviously we also have restaurant. Now we need to calculate whereby we are saying the figure for sales that we have is 369,000. Subtract the sales returns figure that we are given there, which is going to be our 200. So the net figure that we are supposed to get there is 368,800. So we are saying 368,800. So these are the respective figures that I'm going to put in terms of the takeaway department and then the restaurant department. So we go there and put our final answers. So in the takeaway department, we are having 534,000. Then our restaurant department, we are using 368,800. So here we put 368,800. Then going back there, you see that after sales now, we are now saying less cost of sales. Here we say less cost of sales. we check if you've got the figure already calculated of cost of sales. So if you go down the information in the list of balances, you'll see that we do not have a figure for cost of sales. So if you don't have a figure for cost of sales given here, it means you have to calculate it by using that formula of saying you open stock, you add your purchases, you subtract purchases and sales if they're there, you add your carriages on purchases if they're there, then subtract closing stock to get your cost of sales. So we start with our opening inventory that we have, which is we have opening inventory is this one, 1 July 2012, and we've got 116,500 for takeaway, and then for the rest of the department, we've got 70,000. So these are the opening figures that we have for opening stock. So we come here and indicate our opening stock. So say for takeaway department, the figure that we have is 116,500. And then for rest of the department, we put 70,000. And from there, we are supposed to add our purchases. So we say purchases. The figure of purchases that we have to put here to be the next purchase figure. So you come here and we check that the figure for purchases that we have, we've got 190,000 for takeaway, and we've got 160 for the restaurant. So that's what we have. So we can come here and try to see if we've got some returns, and to see that we've got purchase and returns here 195 and 2,500, which we need to subtract from the figures for purchases to get the net purchase figure. So let's just try to create some space there. So on the calculation of purchases, we are saying start with for the takeaway department for purchases, we are saying the figure that we have for total purchases is 190,000. We say 190,000. Subtract the figure of purchase and change 195, which is our 195. Give it 195. So this is what we have. And then remember, we have got if you go to the additional information, let's just try to see in terms of the additional information. If you come to additional information number, so remember you have gone through all this additional information, so you do know that there is a certain a note that needs us to refer to for the calculation of a certain item. So in particular, our purchases, if you go there, we've got an adjustment that needs to be done. Let's just try to go through every element that we have in the additional information. Additional information number 4. It reads on credit February 2014, bread 500 rands cost price was transferred to the takeaway department. So if you have a transfer like this, remember, go at the beginning of our question, you'll see that there is an instruction that is given there in terms of the business operates using the periodic inventory system. Remember, there are two inventory systems that are used. You've got the perpetual inventory system and then the periodic inventory system. So in the periodic inventory system, movement of inventory is recorded in the purchase account. But in the perpetual, that's when it's recorded in the credit stock account or the inventory account. So in this case, we're using the periodic inventory system. So we are going to record that movement in the purchase account. So what you are saying is the movement that is being explained there of bread from was transferred to the takeaway department. So it means it was coming from the restaurant to the takeaway. So it means the takeaway, we're going to add 500. So basically, and then in the restaurant, we're going to subtract 500. So that's exactly what we have. So here, coming here now, we are saying, Here for takeaway, remember it's coming to the takeaway. So we are going to add a 500 here. Get the final figure for purchases for our takeaway. So we can just try to calculate whereby you see 190, 190,000, and then you subtract 195, and then you add 500. Again, and then you're going to get 190,000, 305. So this will take away. This is the figure that we're going to put for purchases for takeaway. And for restaurant, we are seeing we've got 160,000 is our purchases. So we say 160,000. Subtract our change, which we are giving is 2,500. And we've got these goods that have been transferred from the restaurant, so we're going to subtract again 500. And you see the figure that we're going to get there. So we're saying 160,000, and then you subtract your 2,500, and then you subtract again your 500. And then you're going to get your 157,000. So the answer is 157,000. So exactly this is figure of our purchases. So we come there and indicate our figures. So for purchases now, we are saying for takeaway departments, we've got 190,000, 305. And then we've got the restaurant department, we've got 157,000. So this is what we've got. Obviously, after that, we have added our purchases. We also need to check on carried on purchases. We need to check on carried on purchases, so we can go back to our list of balances to see if we have got carried on purchases in the question. So we go there. So you see that carried on purchases we have it here, and we have 2,000 for takeaway department here, and 6,000 for restaurant department. So before you enter these figures, you need to go to a trend formation and try to see if you've got any adjustment that is affecting carried on purchases. If you don't have, you can just take the figures as they are and then put them in your income statement. So in this case, we do not have any adjustment that is affecting our carried on purchases. So we can take out 2,000 and our 6,000 representing our carried on purchases. So we go there. So we can say the list of purchases now, that's where we're going to have our carried on purchases. Whereby for takeaway department, we're going to have our 2,000. And then for our restaurant department, we're going to have 6,000. Then from there, you can get there to say from opening stock to carried on purchase to get the total. So we can just try to hit there. So having done that now, you see that if you add in terms of the first one, the first column where we are having our takeaway department, and the total, say 160,500 plus 190,305 plus 2,000, so you're going to get to 308,805. So I have got that. We also add the last column where we invested in department 70,000 plus 157,000 plus 6,000. And total that I'm going to get is 233. 233,000. And from there, finally, you're supposed to subtract your, the way you can just say less your closing. The closing stock. So we go to the information that we're given. Obviously, we have our closing stock balances whereby you say on 32 2030, that's where our closing stock balances were with 25,000 for 55,000, sorry, for takeaway, and then we've got 32,500 for restaurant department. So we go and indicate as such here. So we are saying number takeaway department, we've got 55,000. In other restaurants, we've got 32,500. But remember, we're saying less, so we can subtract by showing our brackets. And whereby now we're saying 308,805 minus 55,000, and the other should come here to represent our cost of sales. So if you calculate there, you're supposed to get your cost of sales is 116,000. Sorry, if you calculate correctly, it's supposed to be 253,805. 253,805. And of course, you have to close here to show that you calculated inside the box. So we close here again. So this is what we have. So on the column 4, our restaurant also we are going to say 233,000 minus 32,500, and also we should close. We should close there, whereby we are saying. So if you say you 233,000 minus 32,500, you are going to get your answer is 260, 200,000, 200,500. So we'll say B 200,500. And again, at this figure, we're saying less here. So we're subtracting again our cost of sales from sales and put our brackets. Whereby now we're saying in the takeaway demand 524,000 minus 253,805, and you get your gross profit here, which is going to be 280,000. 195. Do the same in column for restaurant department. 268,800 minus 200,500. Then the answer that is supposed to get here is supposed to be 168,300. So this is the description of our gross profit. And then obviously we know that after gross profit, we are supposed to go to the other income section. So we go to our question and try to see if we've got anything to do with other income. I start with the list of balances, checking if we've got any income that is there, in terms of maybe commission income, rent income, part of our income. If you don't have, I go to additional information to check if we have got any income that we have. This is our additional information. See that there's nothing to do with our income, so we skip the other income section and go to our list expenses. So here we are saying less expenses. So under less expenses again, go to the information given. Try to see if all the expenses that we have in person, list them beneath our heading of expenses. So you go down, checking expenses. So you see that the first expense that we have is carried on sales. The first expense that we have is carried on sales, and we are having carried on sales is here. Sorry, we have got carried on sales here. These are carried on sales, and then we've got 10,600 for takeaway and 4,000 for restaurant. But before you enter those figures, we go to extra information to check if we've got anything that is affecting your carried on sales. So we come to additional information number 5. You see that carried on sales is owed by takeaway department. So 800. So we've got a carried on sales that is still owed for takeaway department only. So it means that whenever we've got an oil, we are supposed to add. So we're going to get 800 and carried on sales of takeaway. So we come in. So we're going to say carried on sales for takeaway is 10,600, and then we get our 800. We're just supposed to say 10,000 600, then we get out 800. So if you get correctly, you'd see that the figure that you're supposed to get there, it's now 11,400. So we are going to put 11,400 for takeaway. Then for the restaurant, we're going to take 4,000 as it is, because there's no adjustment affecting the restaurant. So we come in and start with our carriage on sales. Carriage on sales. And the figure that we are having there, remember for the takeaway, the figure that we have for the takeaway is it's 11,400 after the addition of oil. And then we have for our restaurant, we've got 4,000. So here we have 4,000. And then we go and check again in terms of any other expense that is affecting our income statement. After carriage on sales, we've got sales returns, not an expense, purchase returns, not an expense. We now have sundry expenses, which is here. So we have sundry expenses here, whereby we've got 20,000 for takeaway, and then obviously this one is 14,000. Supposed to be 14,000. Then we've got 14,000 for our restaurant. So we check again if we have anything that is affecting our sundry expenses in additional information. But if you go through, you're going to see that there's nothing that is affecting our sundry expense. So if you check the figures as they are, 20,000 and 14,000. So go to our answer section and say sundry expenses. Sundry expenses. And we are saying the figures that we have is 23,000 and 14,000. So this is what we have. And then go again back to our question. Remember, we're trying to identify all the expenses that we are given in the list of balances there. You've got after such expenses, you've got insurance, but we're given it as a one figure here. So if you are given it as one figure here, remember we've got two departments. We need to see how are we going to apportion them between takeaway department and restaurant department. And you can only get that information in the additional information. So for insurance, we've got 20,500. Let's go to additional information to see how are we going to apportion insurance between the two departments. So we can go to note number 2. We see that insurance is listed here on 18.2 on the first point. 60% of annual insurance premium must be apportioned to restaurants. So it means restaurant 60%. And then takeaway becomes 100 minus 60%. You get your 40%. So this is exactly what we have. So we can further convert our 60% to a decimal, whereby it becomes 0.6. Then our 40% becomes 0.4. So we can just multiply by those factors, whereby we are saying now, go back to our question and see that we have got rent expense. So we've got our insurance being 28,400. So for takeaway, remember it's saying 0.4. So we are saying 0.4 times 28,500. So calculate to see what we get. 0.4 times our 28,500. We're going to get you 11,400. So we've got 11,400. For our restaurants, we are saying 0.6. Then multiply by 20,500. Multiply there, we get to 4,000. Let's try to see 0.4 times 28,500. You see that the figure that we are supposed to get 0.6 times 20,500. We are going to get you 17,100. So these are the figures that we are going to put. 11,400 for takeaway, and then 17,100 for restaurant. So go there. That just for such So this is our insurance. So we are saying insurance for our takeaway, we put 11,400. Then for our restaurants, and we put 70,100. And go back again to check space after insurance, and we'll try to remove so that we can have some space. So we are saying after our insurance, we've got our rent expense here, which is 228,000. So we go again to see how are we going to apportion our rent. Additional information, rent expense is per floor space, very important, per floor space. So let's try to find out the proportion of floor space which we are given at the additional information number 1, which is 80 for takeaway, and then 120 for restaurant. So basically, this is very simple. The denominator, we are going to say our 80 plus 120, and this becomes the denominator for both departments. When calculating, we add there, we're going to get a 200. So basically, we are going to say for our takeaway, the takeaway is 80. So we're going to say 80 over your 200. You multiply the figure for rent that you're given is what? 220,000. We are still going to go over one and see the figure that you get there. Which is going to be 80 divided by 200. And then you multiply by 228,000. You are going to get your figure is 91,200. So here we put 91,200. So we also calculate for our restaurant, whereby we are saying restaurant we've got 120. So we say 120 over the same denominator, which is 200. Then we multiply by the figure that we are portioning, 220,000. Calculate it as such. I see that the figure that we are going to get is 136,800. So we have 136,800. So these are the figures that we are going to include in our income statement. 91,200 for takeaway, 136,800 for the student. So go there. We are now saying rent expense. So for takeaway, rent expense, we put 91,200. And then for our restaurants, we put 136,800. Obviously, we go and try to check what we have in terms of the next expense. Come here, we can try to remove this. So after our rent expense, we also have an expense beneath that, which is our salaries. So we can just come here. We've got our salaries, which is 240,000. We also need to know how we're going to apportion that. We come here. Our salaries are as per the number of workers. So we go there and try to find out about number of workers. So given it is 8 with code. So we're just going to say 8 plus code. And we're going to get your 20. So 20 is going to be your denominator. So for takeaway, we're going to say we've got 8 there for takeaway. So 8 over 20. Then multiply by the figure for salaries, which is 240,000. Over 1. So it becomes say 8 divided by your 20, you are going to get your 0.4, and then you multiply it by 240,000. You are going to get your 96,000. So here we go to 96,000. Then for restaurants, we are going to say restaurant is cost. So we are going to say cost over your 20, and then you multiply by 240,000. That's number one. And then the answer that you're going to get is 144,000. So these are the two figures that are going to the income statement, 96,000 and 144,000. So go and adjust. So this becomes our salaries. So for our salaries, we're saying we put 96,000 and also we have 144,000. Go back to check what's the next expense that we have. So on the next expense that we have there, we are going to see that we have advertising. We check additional information again about advertising must be shared equally. So basically we have two partners. So if it's equally, we divide by the number of partners, which is two. And then we are saying going to say 45,000 and divided by two. That's equally. And we are saying the figure that we're going to get for advertising is 22,500, which is going to apply for both departments. 22,500. So we go and put for advertising. Say advertising. We put 22,500. So after advertising, we also check if we have anything that we have in the list of balances. See that advertising is the last item. So obviously we go to additional information to check any other additional expense that is not listed in the list of balances there. We see that we've got bonuses, which is here, which is saying bonuses must be provided only for the managers for the respective department as follows. Take away 1.5% of the net sales of this department, and then restaurant, we've got 1% of this department's net sales. So basically, we have our percentages 1.5 for takeaway. So we just come in and say for takeaway, we're saying 1.5. So in other words, we're saying 1.5 of 100. And then we multiply by the net sales figure. The net sales figure, get it in the other section. Remember, we calculated the net sales figure for takeaway, and we got 524. So this is the net sales figure. We don't take that one that is in the list of balances. We take the figure after subtracting sales retains. That's the net sales figure. We've got 524. So we multiply by 524. 524,000, and then over 641. Try to see what you get there. Let's try to calculate. You're saying 1.5 divided by 100. Multiply by 524. You're going to get 7,860. So this is the one that we have for takeaway. And then for a restaurant, we're going to say it's 1%. I can just refer back to cross check. We've got our 1% for restaurants. So we go there and say 1%. And 1% obviously is 1/100 multiplied by the net sales for restaurant. So we go there to find the figure for net sales for restaurant. We have already calculated the figure. We have it here, which is 368,800. 368,800 over 1. And calculated in such, you see that we've got 3,688. So these are the two figures that we have, this one and this one. 7,860 for takeaway, 3,788 for restaurant. So we transfer those figures there. So we're saying bonus. So basically, we come here and we're saying bonus, and the figure that we have is 7,860. And then we have 3,708 1,688. And then we obviously go again, additional information, and try to see any other additional expense that we have. We have got additional information number 6. An amount of 1,350 due by customers to the restaurant must be written off as recoverable. So this 1,350 is referring to credit loss or bad debt. So this one is a bad debt because it must be written off, and it's amount due by customers, which means this customer is our debt. So we write it as bad debt, and it's only affecting the restaurant. So it means takeaway, we don't have any bad debts. So we come there and we are saying bad or bad debts. And we have the figure that we have is 1,350 for restaurant takeaway. There's nothing. We check again in other expense are listed there. On the last part, we have got depreciation must be written off on equipment at 15% per annum of costs. So if it says on cost, we know that it's straight line method. And calculating our depreciation using straight line method is percentage times cost. So we're just going to say 15% times the cost of equipment. So we come here and go to the percent. You see that the equipment, we've got the cost price for equipment is the one that we need to look for. So we are saying cost price, remember we are saying, let's start with the takeaway. We are saying a 15%, which is 15 over 100 times the cost for equipment for takeaway. Of which equipment cost price takeaway is what 480,000. 480,000. So we go to multiply by 480, 480,000 here. Obviously over 1. In the final figure that we are going to get there. We'll just try to calculate, let's say 0.15, which is our 15%, and then we multiply by 480,000. And you see that the figure that we're going to get 72,000. So 72,000 is the depreciation for takeaway. Then depreciation for our restaurant, we try to calculate it again by saying 15%, which is also our 15 over 100, multiplied by the cost that we have for restaurant equipment, which is 190,000. And you see that the figure that we're going to get is 28,500. So these are 28,500. These are our two. So 20,500 for a restaurant, 20,000 for takeaway. So we go and update that one. We'll save our depreciation. Takeaway, we are saying 72,000. And then for our restaurant, 20,500. 28,500. So this is what we have in terms of all the expenses that we have in the question. So obviously we can close. We can try to close there. And then we can go as well, try to close there on top. So we are saying we're going to add from our 11,400 in the takeaway department going down to our 72,000 to get the total for our expenses. That is going to be 335,360. 335,360, which we are going to subtract from our gross profit. So yet again, for total for restaurant from 4,000 going down to 20,500 to get the total. So the total that we are supposed to get there is 371,938. and then we'll subtract again this one from that one. So let's start by the takeaway department. We say 270,190, 195, subtract 335,306. The answer that we are supposed to get there comes on net profit or loss, but you see that you're going to get a negative figure, and the negative figure represents a net loss. So we go to negative figure of 65,165, which is a negative figure. So the same, when it's a negative, it becomes a net loss. So we go to the other department, we're saying 168,300 minus 371,938. It's going to be a loss again. Why? Because our gross profit is less than our figure for expenses. So it becomes a negative figure, which is a loss again. So our departments are making a loss. So here we get 203,638. So this indicates that our two departments are making losses. So there we can close. So this is what we have in terms of our calculation of the final figure, which is going to be our net profit or loss. But in this case, it means before all two departments have made losses. So we can just give a description here by saying net loss. So if we got a positive figure here, it was supposed to be net profit. So basically, this is what we have in terms of the preparation of departmental income statement. So the main purpose of preparing this departmental accounts is to make sure that the business identifies departments that are making losses and which are making profits, so that they can strategize in the future to come. So this is what we've, guys. Let's stay tuned for more videos to come. More typical examination questions are going to come that are going to assist us for the upcoming final exam. Let's subscribe and share. Let's share the link to our colleagues who are doing financial accounting info. As for this video, I'm signing out. Let's meet again in the next video.